Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 9th of the 9th, 2024, September 9th, and it is the first day of the infamous APEC conference in Singapore, which I think none of us are at because we're on this podcast, but nonetheless, a pretty important day in the energy markets calendar. The markets yet to get any direction out of the chattering classes in Singapore, with Brent crude oil up a little bit this morning, consolidating closer to $72 a barrel. It's at 71.75, up nearly 1%. So maybe that's a bit of a bump from all of the bullish chatter in Singapore. Let's kick off, as always, Monday morning with Omar Najia, the global head of derivatives at BB Energy. Omar, are we sort of consolidating at the sort of year-to-date lows now, and then there's a rise ahead once maybe we get through the Fed fog?
Look, I think the answer to that is yes, but where the slow actually is quite hard to tell. If you take a step back and you look at crude for the last year, 12 months, say, it's actually down about 20% on the year, right? And as far as I see, I can't see anything that's down. Gold is up 30%, silver's up 25%, copper's up 6%, Bitcoin's up 110%, but oil is down 20%. The S&P, I think, is 11 or something. Oil is down 20%. Why? I have no idea. I honestly have no clue. But look, I think originally we had a point in the sand at 67, 67, which was basically the low back in late 2023, I think December. It took it out on Friday. So it's a very difficult thing to gauge. I think if I think it's looking sick. If you want to kill it stone dead, then it has to be below 64. If this market can get another $4 lower, then I think it's dead. In terms of dead, I think basically it'll drift lower over time. Having said that, you've got the US election, and what you can say about both candidates in both parties is that they are both basically, they're not going to rein in deficits. They're going to basically spend as they have been doing. And I think the same is true of Europe as a whole. So, it's oil as an outlier right now.
Peter McGuire, CEO of XM Australia. Welcome back to the table, Peter. When I hear Omar talking about the market could be dead, or to that of some sort of analogy, I couldn't help but think of the famous Monty Python sketch of the parrot is not dead. This parrot is perfectly alive, so please buy it. Speaking of and starting with all things China, Peter, what's your read on China as we now move out of the summer into the, getting into towards the Chinese winter? Can there be life in that old parrot yet?
Well, it's just sick, I think, Sean. I don't think it's dead, as they say. I think that was the comeback from Michael Palin, wasn't it? There's nothing wrong with that parrot. It's just sick. And good to see everyone, and greetings from Sydney. CSI 300 down in that 3100 range, Sean. It's off around about, I think, 1.2, 1.3% today. So there's structural weakness in the Chinese economy. That's been demonstrated as far as stock market, and it just seems to be grinding lower. And the way it's going at the moment, is there any chance you could actually see in the high 2900s? So there just seems to be softness. There's the first part. We understand, I think, from an export-driven model, the consumption is a lot weaker than what China would naturally want. They're trying to get internal demand, but that's not an easy picture when you've got that huge overhang with property, as we all know, and who's holding that debt. So I think that China's got a pretty tough till the end of the year. It's going to be a hard road, and we've just got to see where it goes as far as other countries with their interest rate policies and how that impacts naturally hard-based commodities. Iron ore's at $90. the likes of copper and the base metals. And I suppose China's fortunate with the energy prices at these sort of levels, Sean.
Let's welcome back to the table from our insight and expert on all things sort of what's happening on the seas, Michelle Weiss Bachmann, Principal Analyst, Lloyd's List Intelligence. Michelle, I wanted to kick off this morning with you on maybe some updated insight to the tanker that is burning on the Red Sea, which is kind of drifted into the background of being relevant to this market. It seems to me a 1 million barrel tanker, potentially to explode, potentially to sink, is still a big deal. What is the latest with that?
Good morning, Sean. And yes, it's lovely to be back. Yes, the Suyunion, the Greek-flagged Suezmax tanker that was attacked by the Houthis, and then after it was abandoned by the crew, it was then set alight. It's been alight for 10 days. It is floating, and the Houthis won't let salvors at this stage come to put out the fire. There is a huge risk of an oil spill, but has it moved the needle in any way with the oil prices? No. Has it moved the needle in respect of interrupting any of the current oil flows through the Red Sea? No, it hasn't. It's business as normal, which I find quite surprising. At the moment, we've got crude transports down through the Red Sea at 31%. Sorry, refined products are down 31%, and refined products are down as well. But there's been no change since then. I find that surprising, such a huge geopolitical event. To extend the parrot analogy, though, I think the parrot's been sick a long time in China. And when I look at seaborne imports of crude, they've been falling for 6 consecutive months, looking at Vortexa data. So alongside the transition, China's energy transition, as well as the economic problems that it has in the real estate sector and in the manufacturing sector, those slowdowns, I think really that is at the crux of the demand problem that we have at the moment.
Michelle, just to quickly follow up on that. Is there any sense, I mean, clearly, as you say, and we're articulating the events on the Red Sea, which there are many months now since the beginning of the year, was this event another level of escalation? I mean, I can't remember the last time during this year of the Houthi attacks on the Red Sea shipping lanes that we've had an oil tanker, 1 million barrels, essentially crippled, burning, potentially, where it goes from here. But ultimately, is this another level event that puts everything into a different risk category, or is this just seen by shipping as business as usual, another part of a same equation? Because it strikes me as being something more, but I'm not in shipping insurance.
Well, you would think so, but I've actually crunched the numbers on the incidents. We've at Lloyd's List, we've tracked 83 of them, and what's emerging is that the Houthis are very carefully targeting the tankers, and so yes, this is a dramatic escalation, but it was a Greek-owned tanker. And I think if anything, this is going to further decisions by Western and European owners, operators, charterers not to send their ships through the Red Sea. When I look at the 83 incidents, I see not one Russian-owned tanker has been attacked. There have been some that have been carrying Russian cargoes, and there have only been 2 Chinese-owned vessels attacked. Those 2 Chinese-owned vessels were leased under long-term leasing arrangements, and the disponer owners were not Western, were linked to Western long-term charterers. So I think the Houthis are becoming more targeted, and that will influence decisions about transits. But it should have moved the needle. It hasn't, but it is a massive escalation. But I'm not really sure why the world isn't taking more notice. 1 million barrels potentially spilling in that area would be absolutely disastrous.
Omar, I mean, looking at for where this market would take direction from, clearly listening to Michelle there, geopolitical risk, shipping lanes, the kind of choke points that have been, sort of annoying the market for this year, but not necessarily impacting it in a noticeable way. Where do you look for the sort of direction of travel here? OPEC Plus announced last week that it was abandoning its plans to raise supply in October. Is that a North Star now? Is it the Fed next week? Where is your North Star at the moment for this market?
No. So I need two things to happen. One, I need the market to hold above $64 WTI. If the market holds above $64 TI and shows some signs of life, then it's worth a buy. But no, I don't think that the geopolitics. I think these are kind of bigger games, right? So the stuff with I don't think the Red Sea as such is going to have an impact on oil prices simply because it hasn't. Okay, but I think the what's going to happen in the U.S. election is the dollar going to continue to fall? Are they going to get their deficit under control? Is Europe gonna start cutting anything, or are they just gonna keep on spending and hoping for the best? It was a very interesting report from Bloomberg, I think, late last week, saying that the US has lost the battle with the Houthis. So the US and the UK came and they put their vessels in and they said, no, we won't allow this, and freedom of navigation and all the rest of it. And now they've basically quietly gone away. And you have ports in Israel which have become gone bankrupt. You have them hitting every Israeli-owned or destined vessel, and the West can do nothing about it. And I think that'll quote unquote continue. But as to the viability of a buy or going long on oil, the only thing I can say is it's the only thing that's down and down heavily this year, and I really can't understand it. So geopolitical effects we've ignored, dollar weakness we've ignored, anything to do with inflation and fiscal exuberance we've also ignored. So when something is ignoring everything that's bullish, then you don't hold out too much hope. So if this thing goes below 64, I think we'll sit on the sidelines and see how low it can get. So I think 64 is an important line in the sand for WTI. Why? Refinery margins, all the rest of it, everything, and as Michelle was saying, the product going through the Red Sea, all of that merits some kind of quote unquote risk premium, delays, all that kind of stuff, but there's none about. So it's beginning to look a little bit, $64 is the last hope, and we've been hoping for a while. So let's see.
Peter, I wanted to get your thoughts on the Fed decision and the size of the cut. You put out on your end of weekend your weekend note from Coogee Beach. I love the name of beaches in Australia. Is this something? It's like I don't know, just creates the imagination. Coogee Beach. There you go. But anyway, CPI, the last data point before the Fed moves, you are asking, will the US CPI back the case for 50 basis points cut? Your answer to your own question, please, and what difference would it make for the oil markets?
Well, a couple of things, Sean. I think first off, the jury's still out. Is it going to be 50? And I think the momentum at the moment is certainly erring to that sort of target. Yes, we've got that number being dropped, I think, on Wednesday. As you mentioned, you've also got structural weakness in the labour market, and you've got to look at the likes of Governor Chris Waller and, of course, Fed President New York, John Williams. They're really concerned about where that labour market is trending, and that really, I think, is more focused than necessarily the CPI read, because they're saying to themselves, we've revised this down for July back to I think it was around about 87,000, 89,000. I've got in my notes here. And it was softer than expected, that NFP last Friday. the momentum is there. It's saying, right, a company's starting to downsize. You're seeing an increase as far as layoffs, which is very evident. So this is the sort of concern that they're worried about. And that's why I think that, as building on what Omar said, I think that everything, the jury's out at the moment. We're waiting to see what happens. And the market's either going to say, wow, it's worse than what we expected as far as jobs and the economic situation in the States. And I really think that they'd have a lot of concern trying to do something again, possibly even in November or December, considering you've got that election. Another thing you've got to be conscious of is the possible government shutdown on the 30th of September, how that's going to work as well. So there's a lot of, I think, moving targets here, shifting sands over the next 21 days, and how that is interpreted from the market.
Would it have an impact? I mean, obviously Asia, the critical demand center of incremental oil demand growth in the world, has been for decades, most notably China. Does it matter to Asian consumers, Asian demand for energy, if the Fed cuts by 25 to 50 basis points? I mean, a lot of those countries carry US debt. What's the impact there and the difference likely to be felt in Asia?
Well, I think, Sean, is there going to be an unwinding as far as equity markets? You've got the Nikkei back at 36,000 odd. We've seen the volatility over the last month and a half. You're going to see structural weakness engage across equity markets. That's the concern. And then where does that roll as far as just market sentiment, market interpretation? And they're the core instincts of any trader. They want to know whether it's a time to be short or a time to be long. And maybe it's and it can be violent. You've been in the markets long enough. It can be violent, and that all of a sudden you see a quick 5 to 10% wiped out across S&P or NASDAQ. You saw a 10% wipe out the other night on NVIDIA. So let's just be very mindful that these things can move very, very quickly. And that's the exciting part of the market.
Michelle, where are we with sanctions? I mean, the shipping, Russia continues to move its oil with ease, it would appear, without any interruption other than perhaps some compliance with OPEC cuts. Where are the sanctions, the dark fleet, the insurance? Where's that whole intersection point? Because again, the market seems to be unimpacted by that.
Well, one of the things to watch with falling oil prices is whether or not the price of the discounted Russian grades falls below $60 a barrel. And when it comes to Urals, we'll be probably getting very close now. I've always maintained that the oil price cap doesn't work. It may have reduced the income to the Kremlin because of the discounted crude, but Western regulators have intensified their enforcement efforts, but they've had very little impact on stopping the supply of crude at this point. Overall, we've got about 7 million barrels per day of sanctioned crude being shipped, and that's about 17% of seaborne trade. And interestingly, what we are seeing is that China is increasing its percentage of sanctioned crude. It takes, I think I looked at the figures this morning, 27% of their seaborne imports are from Iran, Venezuela, or Russia. So that very much cuts out some of the OPEC suppliers as well. So I think that's worthwhile watching. But as I said, when it comes to the price cap, it's a flawed instrument, a flawed policy instrument. And I think Western regulators are really struggling to try and make it work.
Let's go to the survey question this morning, which is sort of takes us to where we started. Brent crude oil consolidating at year-to-date lows before rising towards 80 after Fed cuts rates later this month. The thesis being that we're in a Fed fog at the moment without clarity of direction. Markets are in a pause, but consolidating, that ultimately we're consolidating around year-to-date lows on oil and will move higher. Omar, when you take the sort of overarching sentiment concept that you've mentioned a few times today and obviously previously, but that the continuation of sort of fiscal deficits in the United States, the continuation of spending and sort of economic support to the US economy, combined with lower interest rates, whether the Fed moved 25 or 50 basis points this month, the markets are telling us, the forward curve is telling us that rates are in a declining now, in an easing phase, and will continue to do so over the next year. The combination of all that sentiment towards easing, towards more fiscal deficits, what does that lead to you from the point of view of direction of travel? Does that indicate a weak economy that needs all this easing support and so demand declines? Or with all this easing and support, demand goes up? Where do you take your direction from this clear new direction, which is easing, support, cheaper money, more fiscal deficits?
So you're going to get more of all of that. The reason is not to do so. The Fed isn't cutting because the economy is weak or the economy is strong or any of that. The Fed is cutting because they're now spending about $1.2 trillion a year on interest payments. So they're going to cut no matter what. Whether inflation comes up at 17% or 1% or anywhere in between. The only game in town is basically lower interest rates, lower debt payments in terms of interest payments on the debt, and basically try and inflate the debt away. It's the same story in the entire West, the entire G7. I mean, you can look at Japan as the kind of, front runner, closely followed by the US and then the whole of the EU. The only way they can manage their economies is basically to inflate all this debt that they have away. There's not going to be any rises in productivity. There's not going to be any resources that they discover under the ground to be able to sell. Energy prices going forwards because of sanctions, etc., etc. All the oil now is in the hands of the BRICS, and they're just going to have to pay much more for it. So the entire European model, the German model, basically take cheap energy, pay $30 billion for gas and energy, and turn that into a manufacturing powerhouse and sell $2 trillion of stuff. That's all out the window. Forget it. Germany's imploding. So basically, the only game in town is inflation. Inflate your debt away. So I think basically what you're going to see is the Fed cut. I think they cut 25, not 50. And I think they keep cutting for, the 8 times that they meet next year as well. So they'll just cut. They'll pretend that, inflation is not really there, not really important, that they've beaten it, that whatever. And they'll continue to get, because they simply can't afford their increasing deficits. If you look, their debt now is over 35 trillion. It's going up by $1 trillion every 100 days. Every 100 days. I mean, even Elon Musk is tweeting like, unsustainable, blah, blah, blah. The West, you can't continue to live by basically printing money. And basically, the use of sanctions, so nobody, why would you exchange a bar of gold for a US dollar? Because they can basically take that money away from you at any time, even if you're
the value of that US dollar to that bar of gold has halved in the last year. Gold is now double what it was, which tell you that that dollar is under stress. Peter, meanwhile, the opposite side of that sort of inflation is the deflation concerns. We mentioned there Japan. China's core inflation cooled to the weakest in more than 3 years, as published today. Again, bringing back concerns about deflation, Chinese consumers not spending. How big of a concern do you think that is? We had it sort of pop up about a year ago, deflation in China. It seems to be still there and maybe becoming more pronounced. Your thoughts on deflation like we saw in Japan? Is China following the same model as Japan over the course of the second half of the 20th century? Japan, of course, as we know, became the bionic economy with more than half of the top most valued companies in the world in the 1980s, and then fell off a cliff. Is China going to go that same route? How big of a concern and issue is that?
It's a big concern, Sean. I mean, that overhang, we start with the property sector. Michelle touched on it briefly, and you can't argue about it. The size of it and the depth of it and the global impact from a contagion standpoint, who is holding that debt. Secondly, you've got the CSI, as I said, it's now through 3,200. It's been punched down again today, down 1.25%. There just seems to be, again, structural weakness. Yes, deflation. You've got to remember that China sells a lot of stuff. It imports a lot of metals, and they import a lot of coal from us and a lot of iron ore, and we give them energy in the sense of, for power plants and everything that goes into that, and those finished goods get exported or they steel. But you need consumption to buy those finished goods, and this is the great concern that China's facing. There's structural weakness globally as far as being able, people are tapped out with credit card debt in the West, and the internal issues in China are very, very concerning for their government, with high youth unemployment.
But why isn't the government doing any kind of bazooka sort of problem solving here, or are we misreading their decision making?
Well, I think you need people to be able to work, Sean, and this is a great concern because you've got high unemployment. So yes, they can do certain strategies and certain stimulus measures, but the reality of the matter is you've still got to fund it, and you've still got structural weakness in the economy. And this is where many people and many analysts are saying, how does China move itself out of that? And from a deflationary standpoint, it seems to be grinding lower. So I'm curious to see where it runs by the end of this year, because if you're looking at a chart, we're well down from those 3,700 highs of the CSI, which was only in April. It's been a very bleak summer for them so far, and it just seems to be a race to the bottom.
Let's get the survey result and give Michelle the last word here. The market outlook from the point of view of, are we consolidating? Are we not? Is there more lows to be had? General agreement in this room that we're consolidating before moving higher. Michelle, is there anything in the tanker rates, in the shipping rates, in the world's most popular sort of cargo routes, West Coast America to East Coast or West Coast of China? Is there anything to indicate there that we are indeed moving into another phase, or are we going down? Are shipping rates indicating anything to us?
Well, at this time of the year, it's the slowest time of the year, September. October is typically when you see tanker rates shoot up, and that tends to reflect the increased demand from refineries, especially in Asia, to produce more gas oil for the Northern Hemisphere winter. So the fourth quarter is always, typically the strongest quarter. So we've seen no indications as yet that it's going to be a good quarter. I've looked at, some of the forward freight markets. They're not signaling that it's going to be particularly strong. And I think the reason that sentiment at the moment isn't that high is because when you look at demand growth for next year, it's going to be, I think, 1 million barrels per day or lower, depending on how bullish or bearish you are. And I think in Europe, and especially, we know that diesel demand has probably peaked. And now I'm reading for the first time opinions that perhaps diesel demand might be peaking in China. So I think overall, that's not a good indication that we're going to have a really strong year from a demand perspective for the tanker sector. But then, of course, the tanker sector is also influenced by ton-mile demand, which is, because of the recalibration of oil trades from Russia and the Red Sea, has helped keep rates higher than you would normally suspect in these kinds of market conditions.
I mean, the longer travel journeys around the southern tip of Africa because of the Red Sea problems. We also had obviously problems previously in the Panama Canal due to water levels. But these longer journeys, are they still part of the equation in terms of rates and the availability of what you need?
Yeah, for the moment, yes. And of course, before the sanctions were implemented on Russia nearly 18, 19 months ago, Europe was the major destination for Russian crude, and that Russian crude is now going to China, it's going to India, it's going to Turkey. So that's also a driver of record ton-mile demand that we've seen, and especially on the product side, Diesel that would have gone to Europe is now going to, you know, West Africa, it's going to Brazil, South America, and elsewhere.
Well, we're going to have to wrap it up there. We have a market this Monday morning that seems to be consolidating. Of course, we had the big decision by OPEC Plus at the end of last week to abandon their plans, or at least suspend their plans to raise output from October 1st. They've pushed it 2 months, which of course moves us to the other side of the US election. And then obviously you have clarity from the US election. You get clarity in a few days' time from the ECB and then the Fed. So once we get through a bit of that, the direction of travel, this is still a market in backwardation. It's still a market with low inventories as compared to the 5-year averages. There's reasons that fundamentals would indicate a market that is oversold, perhaps. But we'll have to wait and see. Omar Najee, as always, thank you so very much. Monday morning anchor Peter McGuire from Australia and Boogie Beach, lovely to have you back, and Michelle Weiss-Bachmann from Lloyd's List Intelligence. Really great to have your insights, Michelle, and look forward to having you all back soon. Take care and have a good week.
Thank you, Sean. Bye, Omar. See you,
Cheers,
Michelle.
guys.
Thanks, guys.
Bye.